Hi there. In this video, we will discuss the IFRS 9 standard in detail. This standard is all about the classification and measurement of financial assets. An insurer's assets will include, among other things, cash, financial assets, or real estate. The IFRS 9 standard covers the accounting of up to 90% of Allianz's investments. Two examples are debt instruments, such as government bonds, and equity instruments, such as shares in other companies. However, IFRS 9 does not cover investments such as real estate and joint venture participation. IFRS 9 introduces two important changes for the accounting of investments. 1. It applies a more logical and principles-based approach to classify and measure financial assets. This creates more transparency. And 2, it provides an expected credit loss model that is more dynamic and forward-looking. Let's have a closer look at change number 1. In general, the three measurement categories remain the same: amortized cost, fair value through profit and loss, and fair value through other comprehensive income, or OCI for short. What changes is which method is applied in which case. But how do we decide which asset falls under which classification? Well, that depends on assets' cash flow characteristics and on the company's respective business model. So the first question is, are we dealing with debt or equity? The next question, does the company use the asset only to get contractual cash flows, such as interest and principal payments? Or does it plan to generate profits by trading the asset? While the amortized cost method can be used only for debt assets, the fair value methods can be used for both public equities and debt instruments. The main change of IFRS 9 is a more restrictive usage of the fair value through OCI method. Only debt instruments that are used to collect interest and principal payments are now allowed to be classified under the OCI option. Further, more complex debt instruments, for example, those that may have some equity-like features or non-consolidated funds, must be classified under fair value through profit and loss. Public equity can still be classified under fair value through OCI, but any gains on such equities must be booked directly in shareholders' equity, unlike earlier when they could be reported in the profit and loss statement. Now, let's take a closer look at change number 2. It relates to the expected credit loss model. For simple debt, the requirement is to estimate and proactively recognize expected credit loss. In the past, actual credit loss was not recognized until it occurred. Under IFRS 9, the expected credit loss is based on the risk that we will not be paid the expected amount or at the expected time. This provides a more transparent and realistic picture regarding the credit quality of a company's investments. We hope this gives you a good initial understanding of IFRS 9.